Hello and welcome back, guys. Remember we were talking about assets, right? I'm in chapter 3 regarding merchandise business, right? And there would be two different kind of inventory system that we could be using. Perpetual versus periodic, right? So in perpetual, inventory is always maintained. In periodic, it would take some time to get your actual COGS from a physical count, right? Moving on, what we shall be doing is that we will uh, be basically talking more about assets in detail in this chapter. Then we will first of all talk about inventory, move on to cash, note receivable, uncollectible amount, fixed and tangible assets. Right, then we will do a summary of things and we will talk about gain and loss of assets, gain and loss on income statement, right, and some investments and investment in bonds. Okay, so hopefully I plan to complete this in one video. Otherwise, we will make it two video. Okay, let's move on to inventory. Right. So what is a inventory? Right. So inventory is nothing but uh, merchandise that business produces or brings to sell it to people. Right. That's like what that could be purchased for resale, right? Uh, it could be like ready-made product that they bring and then sell, right? Or it could be bringing raw materials, conversion, and then creating inventory and then selling. So it could be uh, different things, right? So in a trading scenario, it would be ready-made item. In a factory manufacturing kind of situation, it would be raw material that then convert to inventory and then sell it, right? Normally what would happen is, inventory normally has a two different kind of process. So first of all, it's the quantity, determining the quantity, and then the dollar value. Okay, there would be two different things involved in it. So in a perpetual system, what would happen is we would be keeping we would keep a running total of inventory, both in units on hand and its dollar value at all times. Okay, at all times, that's the important thing. Whereas in periodic, we don't do that. Okay, when an item is purchased for resale, our inventory automatically increases. Right, when it is sold, we would immediately reduce it. Okay, we know that inventory are not always purchased at same price, and it might be different, right? So the cost associated with it could be different, right? So how much to expense out would be for the merchandise sold would require using a method to do it, right? Let's say a company has purchased 30 identical items, right, to sell to customers. So it bought 10 items on 2 at $1, 2 3 at 10 quantity at $2, then again 10 quantity at $3, right? So what's the effective cost over here? So 30 quantity, 60 is the effective cost, right? Right. So in this, what happens is, what's the issue? What's the issue then? So if the company sells one item to a customer, the cost of that item, what happens? It needs to be determined, right? Why are we expensing out? Like if we are selling it at $10, we know that account receivable will be 10, sales will be 10, right? But what will happen in case of COGS, right? So how much to book? So how much to get rid of from inventory? Will it be $10? Will it be 20? How much? Right. So what happens when we have to record that transaction? We will need to do debit COGS, or cost of merchandise sold, and credit inventory, right? So in that situation, right, so what kind of valuation method of valuing are we using, right? So if we use FIFO in this particular method, FIFO is first in, first out, right? So what would happen is that, so if we are selling only one quantity, right? So if we use FIFO among this, what would happen? So what's the first quantity that came to us? It's this, right? So first in, first out, right? So from here, if we take 1 at the rate, $10, our profit will be 9. If we do LIFO, last in, first out, if we were to choose this, what would happen? 1 at the rate $3, our profit would be $7, right? So hence, if we choose the average method, our profit will be 8. Why is that? Because 60 divided by 30 would be 2. 1 at the rate 2 will be expensed out. So 10 minus 2 will give us 8, right? Okay, so that's the math basically given over here as well, right? So in FIFO, what happens? We start with the beginning, which was purchased first. We use that to expense out, right? And in LIFO, we use the latest one. So since the latest cost was $3, so our COGS will be $3, right? And revenue would be 10. Our profit will be 7, right? So it just in a increasing market price, FIFO would provide more higher profit, right? In a decreasing market price, LIFO would provide uh, higher profit, right? Okay, and that affects the taxability side of things as well. So many jurisdictions like America allows LIFO. In many other countries, it may not be allowed. Okay, so either we have to choose FIFO or average cost. It just depends, but a lot of people choose to use average cost. Okay, just so that it balances out everything. So it's actually a better method rather than using all this FIFO and LIFO, because it includes the variability side of things as well, right? So it's like it's like a best case. It's like this could be the best case scenario, worst case scenario. This is the optimum scenario kind of thing. Okay. So normally all these things affect, what does it affect? It affects our gross profit. It affects, the ending inventory is also another important thing, right? So perpetual inventory system, right? Let's talk about that. So what happens is, so by entering a transactions into a cost grid, we can organize our data, right? So to determine COGS and inventory balances after every purchases or sale. Okay, so a grid would organize it like this. Okay, sample grid. So let's just talk about this directly. So suppose we have opening balance on 530. We had, like, the inventory unit of 10, right? And that would be, of course, opening balance for this particular month. 10 units, cost was 4, and it was $40 balance, right? We sold something out of it, 1 unit. So of course, cost will be 4. 4 is here. Our inventory balance is 36 now. If we purchase something, we are going to add the unit, right? But what we would do is we would keep it normally separately. Okay, inventory balance 9 at 4, 36, 10 at 5, 50, right? Okay, so COGS method, this column, so normally purchases would include all the purchases that we've bought for resale, right? So what would happen is, so this would have a impact of what would we do in terms of when we make a purchase for this. What would be the entry? It would be a debit merchandise inventory, credit cash, or vendors, or accounts payable, whatever, right? So it just depends. Okay, right. Then in terms of COGS, what happens whenever we sell anything? What happens? We do debit cost of merchandise sold, right? And credit your inventory. Okay, so we do a debit to merchandise sold, and inventory basically decreases in that scenario, right? But the cost will vary based on the method used. Over here it seems like we are simply using that, but suppose if we sell another 1 unit and we keep it as 4, then that would be what, FIFO kind of method, right? But if we were to do average costing, what would happen? This would be, we would have to determine the price by how, 86, right? So the cost will be 86 divided by 19. Whatever the output comes out to be, that would be our cost. In LIFO, what would happen? 1, and we just take 5, right? 5. Okay, that's it. So next is basically the inventory balance, right? So that's the another item in the cost grid. It just keeps a running total of the number of inventory or items with their cost on each different dates, right? So normally it's just a good practice to copy down what was in the stock in the previous date, right? So for the balance and any purchases would be added over here as well, like this. Right. Next is, of course, there is all this journal entry that happens when you purchase, sale, right? So, that takes place as well. Next is, let's look at this. Okay. So, under FIFO, so under FIFO under perpetual system, what happens is, so the items purchased earliest is basically used in COGS. Okay. Items purchased earliest is used in COGS when any item is resold, right? So let's say we've got a starting inventory of $10, 10, right? And 440, right? So now when we do let's say we are selling something, right? So as you can see over here, we have a beginning inventory. We made a sale of 1 unit, right? At the rate 10, right? So in that situation, what happens? We do a account receivable, debit account receivable, credit your sales, right? So for how much? $10. We have recorded the sale, but we need to affect the inventory as well, right? We would need to do debit cost of merchandise sold, credit inventory, but by how much? What method are we using? FIFO, right? So under FIFO, currently we only have one particular value, right? So we currently only have one particular value, Right. So in that scenario, what would happen is, in that scenario, as you see over here, so our cost would be 4 only. Okay. So our COGS is 4 and 4. Okay. You don't see any impact right away. Okay. Now our balance is a 9 unit left, 36 value, right? We made a purchase of 10 units at 5. So what would happen? Our inventory would go up. So to increase our inventory, it's an asset. What would we do? Asset would have a normal balance of debit. To increase, we do debit inventory accounts payable or cash if we are paying in cash, right? So that would be recorded, right? Debit inventory, credit accounts payable. Next, when we do any kind of sale after that, what's our balance now? Our balance would be 9 units. You would not add 19 at the rate, something like that. Okay, so what would you do? You would keep the balance of different costing in different lines, basically, in inventory balance. So $9 at 36 is there. When we purchase anything, we would just simply copy it down across $10 at the rate 550, right? Now when we are selling 12 units. Okay, 12 units. So what would happen is, when we record our cost of merchandise sold, how would we record it is, we would separate out the quantity. Okay, so we would uh, put $9, 9 units at the rate 4 first. Okay, then the remaining would be what, 12 minus 9. How did we get 9? Is basically, we have to, first of all, just assume that we have to get rid of all the old items first. Not old items, but the earliest purchased items. Okay, so we got rid of all this uh, inventory first. Then what happens? So we sold 12. 12 minus 9 would be 3. 3 would be additional that we need to sell, right? So 9 at the rate 4. The cost would be copied down from here itself. And total is just multiplication, right? And remaining over here is 3. 3 would be sold, but what would be the cost? The $5. Okay, so since it was not enough, na, it was not enough. 9 was not enough to satisfy the sale demand, right? So we had to borrow some 3 quantities from here, so which had a cost of this. So we have to keep it at separate line to get the cost. Okay, now when you look at this, now what's our cost? Our cost is 51. Okay, so in this scenario, what would we do? So our sale is 12 units at the rate 10. Our AR would be what? And debit account receivable 120, sales of 120. But when you record our merchandise sold, what would you do is, you would record 51, as you can see over here, based on both of them. Okay, based on both of them. But okay, so what happens is, it's FIFO is just a method of choosing, which one to take first among our balance. Okay, balance, among our balance, among this balance, among this, which one to use in our costing, basically. So we would get rid of the previously, for the first item that was bought, and then we will move on to the next one. Okay, if it would have been LIFO, what would happen? We would have taken 10 first, and then 2 from here, because we are selling 12 units now, that's why 2 from here, 10 if it was LIFO. Okay, similarly, when we purchase anything, of course, $60 was added to the inventory, right? Next is what? Next is there is a sale that happened again, right? So in that situation, we would get a $60 revenue. And what would be the costing now? We have bought something over here. So after the three was sold, our remaining balance was seven, right? So seven at the rate five was there, not four, because out of 10, what was remaining was seven, right? Because we had to get rid of three, because nine was given out and three was given out because we sold 12 na. That's why. All right, so now seven is remaining at the rate five. All right, now when we are selling six, what happens is, do we need to we just take it from seven, because 7 is enough to satisfy our demand, right? So we don't need to take from 10. We can even there will be a balance remaining on the 7 itself. So when 6 is sold out, the balance would be 1 remaining in it, right? In that costing. So 1 at the rate 5, 5, right? 10 at the rate 60. Right. So what is the total sales? So total sales is basically nothing but just the number of quantity that we have sold. I need to change my color. So it's just nothing but the quantity sold, right? So sale was what, a 1 over here, and 12 and 6, 19 units, right? So 19 units was sold at 10 units, so it would be 190. Our COGS would be different. It would be $4, 36, 15, 30, right? So $85. So what would be our profit? It would be 190 minus 85, 105. And our balance on inventory would be how much? 11 units at the rate 65, right? $65. Okay. Similarly, in LIFO, when we are coming to LIFO, what happens is, so remember, so the first transaction would be same. Remember, because there is only 10 units, $4, right? So even LIFO, FIFO, LIFO, everything average would be same thing for the first sale. But when we purchase something, $10, right? So what would happen? 9 and 10 would be there in our inventory balance. Now, when we sell 12, as I told you before as well, first we take out from the latest purchase, then we move to the oldest one. Okay. So what happens is, so 10 would be completely diminished because our sale quantity is 12, and then we move on to the earliest purchase after that. Now our balance would be what? 7 units, but from this valuation, from this costing. Okay, $7 into 4, 28. Okay. So similarly, when we make a sale of amount that is less than, we purchase again 10 units, and then we have $10 at the rate 6, right? 60 is there. So what would happen? So 6 is the only quantity that we need to sell. So 4 would be remaining over here, right? So $7 would not be touched, it's not. So items which were purchased earlier would basically not be touched whenever possible, right? But if the quantity of latest purchase exceeds, if the sale exceeds the latest purchase quantity, we would have to touch the earliest purchase. We just move on, kind of thing. So we go over here. If this does not satisfy, we might have to go up as well, right? So there might be different valuation based purchases out there, right? So it just uh, depends. Okay, it's if there are multiple costing, we just simply move upwards basically. Okay, in that scenario. Okay, now under LIFO, what happens is there is a subtle variety. Okay. Mm, So 190 would be revenue. Revenue would be same, but there would be a difference in COGS. Okay, our profit is less, right? It's 92. It was 105, and LIFO, right? Our inventory, our ending inventory is also different, right? Similarly, in average, what would be done is it's a little bit different. Okay, so of course the first and second transaction should be same as I told you. When we buy something, na, what happens is you don't need to record it in two different lines basically. Okay, so you have a balance of 9 at $4 and it's 36, right? You purchase something $10, 10 units at $5.50, right? So what would be the inventory balance in this case is basically you would add the the dollar value side of things, so $50, and then the remaining was 36, right? So 50 plus 36 divide by 10 plus 9, 10 plus 9, okay, you would get 4.53, right? So that would be your costing. Okay, so how would you do that is basically, just uh, think of it like this. So $10 at the rate 1 would be 10, $10 at the rate 2 would be 20, right? So this is 30, this comes out to be 20. So what would be 30 divided by 20? 1.5, I guess, right? So that's your, this would be your inventory balance in average method. Okay, that's what we are doing over here as well. Same thing is done over here. So when we are selling to 12, we don't need to worry which one to, which costing based line to choose from, it's not required basically. So we do 12 at the rate this cost, and then we put the remaining balance as it is, right? Next, when we add something, again we need to do 50, 60 plus 31.71 divide by 10 plus 17, right? 5.39. Our costing has increased because we were purchasing this at 6, right? If it would have been, 4.53 itself, it would not change, right? But if the prices of stuff goes up, our average costing will also go up. Okay, and in the last one, of course, when we sell it, of course we sell it at the new cost rate, and our balance would be 11 left, right? And what would be our profit when we look at the total? In total, 190 would be revenue. Our COGS would be 190.7 when we add all this thing up, and our gross profit would be 99.30. Ending inventory is 58.78, right? Okay, so what happened now? Let's compare. So under perpetual system as well, whatever method of valuation we are choosing, what happens is our total sales would be same, revenue won't be affected, but our COGS will be affected, right? Cost of merchandise would be affected, and that would affect our gross profit. In this scenario, which is giving us most profit, FIFO, LIFO is medium. Uh, I mean, average cost is medium, and LIFO is giving the lowest profit. What about inventory valuation? What would happen in that is basically FIFO would give out the valuation would be higher, LIFO lowest, average cost would be average. Right? Okay. So that's what happens when we use different uh, costing methods. So in a increasing market prices, it's different. Right, FIFO would win. In a decreasing market price, LIFO would win. Average cost would be mostly, it's more about, it does not fluctuate much compared to that other two. So yeah, this book is just explaining regard the same thing. Right, so gross profit is $13 higher than under FIFO than LIFO, right? As you can see, as I mentioned, the point, right? So when the costs are rising over time, right? So FIFO would win, otherwise LIFO would be, if it is decreasing over time, LIFO would, a LIFO method gives a higher profit. Okay. So average cost method is basically between the two. So next important uh, inventory system is, another thing that you can also do over here is, basically, you can just compute some things over here, like, what's the opening inventory? $40, right? $40 plus what was your purchase? 110, right? Minus your closing inventory, right? So this would amount to, it's a little bit different. It would be a little bit different. It would be a little bit different, but if the question was proper, it would have been all right. And so, okay, it would be better over here. Let me just do it, understand, make you understand this thing as well. So when the opening was, we normally tend to use this formula to get COGS, right? So opening inventory plus purchase minus your closing stock, right? Opening was what, 40, plus the purchase was this and this, 110 minus 52, 140 minus 52 would give out what, 98, I guess. Yeah, 13 minus that, 5. But yeah, that's how you basically calculate, this is the formula of doing it. Okay, so we will look at that in the next valuation system in more detail. So periodic inventory system is, what happens in this is, basically companies do not, keep on running, or do not keep ongoing running inventory. Okay, so company basically, they choose to wait until a accounting period, or just before, the year end or month end, they do a inventory count. Okay, so when they do a inventory count, what happens is, so they count, how much ending inventory is there, and how much inventory they have sold can be determined. Right, and that can be determined. Okay, So, cost of merchandise sold or how much they have sold is basically first calculated by using beginning inventory plus purchase during the period, right? So, how it is done is basically, so we have our beginning inventory, right? Beginning inventory is there. We purchased $50 and $60. That's our goods available for sale, right? So, of course, it can't be more than 30 units, right? Because we purchased 10 units, then we purchased 30 units was there, right? So, what happens is, so when we made a sale of 1 unit, 12 unit, 6 unit, right? So what happens is our total units sold is 19, right? Ending inventory has to be 11 units, right? 11 units. So this is same regardless of what kind of inventory method we are using, right? Regardless of what kind of inventory methods we are using. Okay, this would be 150 now. Right. So earlier I was trying to show you the same thing. Okay. So 150 is there, right? If we are, selling at all this cost and we've got this 11 units remaining, right? 11 units at the rate, some kind of valuation rates, right? So in that situation, our COGS will be different basically. Okay, under FIFO, what happens in periodic system is basically what's our cost of merchandise? It would be uh, $10 at the 10, so 19 units are withdrawn, right, are drawn from the earliest inventory in stock, right? So 10 units would be withdrawn from where, from this first, right, $44. Next 9 units would be from $5, right? And remaining quantity is what, 8 units, right? We had what, 19 units available for sale, so we have sold what, 19 units. Okay. So our that would be there, right? So this would give out a total costing of COGS of 85. Okay, so there are remaining what, 8 units remaining, right? So the 11 units in the ending inventory include the remaining 1 unit from the $6 purchase. So it's a little bit, this explanation is not so good. I don't like it. No, I don't like it. It would have been better if it was in a chart form kind of thing. So what it is essentially trying to say is nothing different, but so let's just do a simple math over here. Simple math over here. Okay. So our COGS would be, yeah, right. So when we sell 1 unit, we take it out from this particular unit, right? So beginning inventory was 10, right? What's remaining over here? 9 is remaining, right? When we sell 12, what happens? We diminish out the whole thing and we have 3 remaining over here, right? And when we sell the 6, we have 3 is gone, 3 is remaining over here. Right. What happened? Where did I miss? This is 30, right? Okay, 9 is, no, why did 9 go? 9 it should not go. It should be one that should be gone first of all, right? So first it would be now one would go, then three would go, or even nine would go. Right, from here three will be gone. Right, then we need to sell another six, right? So that means three more and three more. Still not making it up. So balance would be 10 at the rate 4, right? 1 at the rate 4. I'm doing LIFO, huh? 9 at the rate 4. Right, we purchase 10 at the rate 5. 9 at the rate 4, 10 at the rate 5, right? So when we sell 12, 9 at the rate 4, 3 at the rate 5, what would happen? 7 at the rate 5 will be there, right? There is a purchase as well now. 10 is there at the rate 6, right? So 7 at the rate 5, 10 at the rate 6. Now we sold 6, right? So what happens? 6 at the rate 5. Okay, so what would happen? 1 at the rate 5, 10 at the rate 6. Okay, so this is the balance. So it would be 11 units, of course. Right. So this is the balance that's remaining in it. And we need to calculate the COGS, right? So what would happen in that scenario is basically we sold all this. So our selling details are over here, right? So what would happen is it would be $4 for this, 436 over here, and 15 over here, and 30 over here, right? So it would be 4 plus 36 plus 15 plus 30. Okay, this would be our COGS basically. Okay, this would be our COGS. It would be same. It would be same basically as we did for this. It would be similar sort of chart for but for FIFO. This one. It would be same. Okay, 85. If you see over here also it's 85. Right. Over here also it is 85. Okay. Okay. So when 85 is there, of course, in terms of ending inventory, it would be what? As I told, $1, 1 into $5, 10 into $6. So $65 is our ending inventory, right? So how many was sold during the period? It was 30 units, right? So I mean goods available for sale, not sold, but available for sale. Available for sale is what? Opening plus purchases. So opening was what? It was 10 units was there. We purchased another 10, another 10. So it was 30 was available for sale, right? 30 was available for sale. Okay. And you can calculate the cost as well. So this is goods available for sale. These are the sold quantity. All right. So what this thing is doing is basically nothing but this 10, it's saying first 10 from the beginning inventory, right? This 10 is basically, 1 plus 9. Okay, because we are selling what? 1 unit over here, then we are selling 12 unit, right? But we need to get rid of what? The first, so since we have at $4 costing, we have what? We have 10 units, na? 10 units, right? So that's why we need to do 1 plus 9 plus this 9 unit is basically 3 plus 6. That's how they got 9. That's why I told you I don't like this. That's why. Okay, so in the expanded form, it would have been like this. Okay, it would have been like this. 9 into 4 plus, 1 into 4 plus 9 into 4 plus 3 into 3 into 5 plus 6 into 5. That's what it was. Just the sum of all your costing, basically, all your sales, COGS. Okay. And under LIFO, it would have been, so since how much stock are we selling? Of course, 19 of them, right? So latest inventory is used, right? So we are selling 19 units, right? So what's the latest purchase was 10 units, so 10 units into 6 and 9 units into 5, right? Yeah, 10 and 9. Okay, so $60 and $45, that comes to 105. Ending inventory would of course be $1 remaining. So since we have what, 10, 10, 10 was the purchase, right? So we sold how much? 19, right? So was 10 enough to satisfy the demand? No, we took from here as well. Let's just look at that 4, 5, 6. Okay, so it's like this. Okay, so in this scenario, what happened was basically we sold 19 units, right? We took 10 from here, then remaining 1 from here. Okay, remaining 9 from here. Okay, so that's why 10 at the rate 6, 9 at the rate 5, and what's the remaining? It would be 1 remaining on this and 10 remaining on this, as you see over here. That's the ending inventory. 1 into 5 plus 10 into 4. Okay, so of course our total cost was 150. Our goods available for sale was 150, of course, right? Only change is your ending inventory. It's 45 over here. Over here is 65, right? COGS is also changed, okay, because of the method chosen. Similarly, in average cost, what would happen? We would simply divide, right? 150 divided by 30, $5 is the unit, right? What's the number of units sold is basically 19 into 5 is 95, remaining is 11 unit into 5. That's our ending inventory. So under this method as well, what happens is, so what happens is, uh, so your total sales remains same. Our COGS, what happens is, it's 95 in average cost. LIFO, FIFO, right? So FIFO has the highest profit, right? Profit, if you look, it's similar, right? Similar. Our ending inventory is there. right? Our ending inventory is there. Okay. So next thing is basically, whatever method we are using, everything would be basically same. Okay. So gross profit is a little bit different, right? So of course, when the prices are increasing, FIFO is better. Otherwise, LIFO is better. LIFO is better, right? Next is regarding lower of cost or market valuation. So normally, uh, companies they follow principle of conservatism. Okay, which means that normally they take in least favorable scenario, worst case scenario, so that people don't. It's like just conservative kind of thing. Like they don't want to overstate their financial information, so that's why they normally do a valuation. How much can they sell it for, or how much does the inventory cost outside. They use all this valuation method to determine the inventory. Okay, so why do they do that? Is basically it's to avoid a misrepresentation or overstated, right? So suppose if our inventory we made suppose costed us $20, but the market value is only $15. So if you put this $20, that's not good enough information, right? But because you can only recover 15 out of it, right? So we will need to adjust for the $5 difference in per unit basis. So even if we purchase it at 12, 20, right? If the value decreases to 15, what happens? We will need to incur the cost, na? Okay. So in this scenario, what is the market value is basically nothing but replacement cost, or what the item is selling for today, basically. That's what it is. Okay. So whichever is lower, we normally take that. So suppose it costed us 20, and the current market value is 15. So what would be our closing inventory now? Inventory is not this, lower of which is lower. This is lower, na? So that's why our ending inventory will be 15. Okay, lower, lower of. It's just a, why do we do that? Because of principle of conservatism. Okay, as you can see, it's presented over here in the balance sheet as well. Right, so we've got this inventory grid, right? And the information in the white cell is given, the gray are the sales, right? So uh, this is the quantity, unit cost, market price, right? So our total cost is this much, market price is this much, right? So our total cost is 160, and the market price is a little bit different. Okay, so what would happen for each different item, for each different commodity, what would we do? So if our cost is 60, right? If our cost is 60, but the market is only giving us 50, we would take 50. For B, our cost is 200, market is 220, we would keep it at 200, not 220. Why? Because we need to take lower of cost or market, right? Because of conservatism, conservative principle. Okay, so it will be 200. So similarly 240 would be there, 120, right? So our total cost would be 16. Okay, our inventory valuation. Okay, so this is what we would report in the balance sheet as well. Okay, so inventory would be 610 and $40 would be our loss. Okay, so there is an example given over here. What happens? So there are two different models. Okay, so the valuations, uh, if we don't use lower of cost or market, what would happen? So we bought 200 units of model 1 at $100. It's 20,000. Second model, which were purchased 2 years ago for $100, but the market price has what decreased to $60 already. Okay, so what would happen? $200 at the rate $100, our valuation is what? 40,000, right? But if we use uh, lower of market cost or market, what would happen? Model 1 would be same, costing would be same, but for model 2, since we are only getting $60, right, per unit, so our costing would change to 32,000. So there would be a $8,000 devaluation of inventory. Okay, that would be there. Next, it's a good to know thing. Okay, so it's a good to know thing, but understanding the perpetual and physical inventory system is more important. Next is physical inventory count. Right, so since the company in perpetual system, they would keep a running total, right, and they would do a physical inventory count as well, even in perpetual as well sometimes, right. So sometimes there might be breakages and everything, right, so it should be there. Okay, so what's not counted or what's not included in physical inventory count is basically if something has been sold, has agreed to sell someone, that's not included there. Okay, so anything which is in transit is also not counted, of course, right. So items in warranty, repair, right. So where if the item transfer ownership has been transferred, that's not counted as well, right. So items returned by customer, this would be included, right. So items held but customer has not paid, that means the transfer has not occurred, that would be included. Okay, so normally what would happen is, like, you've got this 100 units of books and you normally someone has already paid for it. What would you do? You would keep that thing aside, na? Right, so if 20 was there, you would only count 80 from it, right, because 20 is not yours, right. So 20 would be collected by the customer. He has already paid for it. So you would only count 180 books out of the 100. That's what it basically means. Okay, just basic common sense. Okay, next thing that we also need to count is, of course, all the locations should be counted. Right. Whatever other parties has agreed to sell to the company. Right. So out of warranty, repair, right, items the company has purchased but are in transit, as I mentioned before. Right. So if the shipping terms are FOB shipping, right. So if it was, FOB shipping, but the company has sold, that's not required. Okay. But if it is destination, it has to be counted. because it's not yet delivered, na? That's why. What is this FOB destination? So, who is owning the cost, the buyer or seller? That's what it basically means. Okay. So, FOB destination means the company is bearing all the cost to uh, make sure that inventory reaches its destination. Whereas FOB shipping is the company is bearing the cost when it is purchasing, because that's already ours now. Because when we are already as soon as it gets out of the business, it's already ours if we are using FOB shipping. Okay, if it was FOB destination, after it comes in into our warehouse, then only it would be our inventory. Okay, so there could be different errors in physical inventory count. Right. So let's just assume a business reports what it counts as inventory. Right. Assume the correct amount of the inventory on hand is 20,000. Right. So 20,000 is there. Right. And we will need to look at the COGS, of course. Right. So understating. So in case of understatement, what happens? Right. So if we made a mistake and counted only 19,500, what would happen? So initially, what would happen? Our COGS would be less, or it would be more, right? It would be more in this scenario, right? So what would we need to do? Of course, we will need to decrease our COGS and increase our inventory. That's the correct value. But just look at this, the effect of it. So of course our merchandise inventory is understated by 500. It should have been 20,000, right? Our total assets are understated. Our COGS is overstated. Net income is understated, right? It should have been 80,000. Return earning and shareholders equity is also understated, right? When we overstate things, overstate merchandise, so if it was 20,500, what would happen? Of course our inventory is overstated, total assets it's overstated, our COGS or COGS, what happens, it's understated, hence our profit will increase, right? And retain earning, total equity will also increase, right? So physical inventory affects overall financial information, right? So these are the things that we have covered. Right. So next asset detail that we will be covering is regarding cash. Right. So normally, whenever we have any cash in, we normally debit. Whenever it's paid out, we do credit. Right. So normally a checking account is there at a bank normally. Right. So where we normally use this to safeguard cash. Okay, so rather than using a savings account, so checking account is basically, which is more frequently used compared to savings account, of course, right? So businesses normally open checking account to do their regular transactions and all. Yeah, right? So this could be writing checks or electronic fund transfer as well. But whenever you look at the statement, it would definitely look like this, or your cash ledger would definitely look like this, right? So, of course, a bank statement normally has beginning balance, deposit, withdrawals, all these things are there. and we would basically get the differences out of it, right? So there will be a bank reconciliation that needs to happen. Right. So bank reconciliation, basically what it does is it's basically uh, it's just reconciling, reconciling your books versus bank. Okay, so sometimes the bank charges $20, but we don't know in our books, right? So whenever we get the statement, we pass that entry into our books as well, so that our books bank balance and actual bank balance is similar. So bank reconciliation, it should be completed as per company policy, I would say. Uh, Somewhere it's monthly, somewhere it's different, right? But with online statements, it's more easier, right? So what would happen is, so there would be a twofold process. So bank reconciliation is mostly twofold process. Okay, so our company's ledger states 8455 as the month end balance, but the bank is saying it's 9235. So what would happen is, so we would analyze individual transactions. Okay, so deposits that are there in the bank statement but not in ledger, what we need to do, of course, we will need to add it to our ledger as well, right? So such as electronic transfer, collections, right, and withdrawals. So that are there in bank statement but not in our ledger, such as payment to a vendor. Some people might have missed it, right, to record. So checks returned, so we issued a check to a vendor, but it was not cleared. So basically we recorded it as we recorded it, right? So that was issued, but was not sufficient, right? So in that scenario as well, we could do that, minus 900 bank charges, right? And so adjust for any errors in the ledgers, right? So there could be, you know amount was entered as 80 rather than 800, so remaining balance is 720, right? So we might have to deduct that as well, right? So after reconciling, what should happen is basically your books balance and banks balance should be same. Okay, you might have to add few things over here, right? So like uh, we recorded it as outflow, but what happens, it's not cleared. So you might have to add that as well. Yeah, right. But overall, your ending balance of bank and your book should be matching. Similarly, in a bank side as well, what would happen is, let's say you've got this much uh, bank's balance, and the bank has not yet list yet being the deposits not showing up yet. In that scenario, we will add, right? So checks which has not been presented, right, uh, that can be subtracted, and based on that we will get a value 9235, right? So we will basically, we can do it from both perspective, right? So our adjusted result for both of them will be, should always be same. Okay, should always be same. We've got all these transactions, Right, so we might have to use, we might have to, we will need to create a journal entry. Right, so to do all this, we create such kind of journal entry, which will basically, there will be a cash or bank or whatever account we are using at one side of it always. You see, cash, 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 right? So whatever we have identified, we basically record it. Okay, so that we are recording every transactions. So after all these things are done, it would the ledger would have the impact of it. Sorry, as such. Another thing is basically there might be another expense that can be occurred, such as incurred whenever we take any electronic transactions. There might be processing fees that we need to pay, right? So that's an expense for us. So bank card expense, right? And debit bank card expense, credit your cash, right? So it's a expense account, right? So to increase, normal balance is debit. To increase, we use debit, otherwise credit, right? Similarly, in case of notes receivable, what happens is, what is note receivable is a business which can lend money to individual or a customer. That's note receivable, but it's normally for a short time. Okay, so what happens is, so a company received 60-day $12 note for $1,000, right? So how would we record it? First we would record it mm, as receivable, right? So in our books, what would happen? So suppose we are a giver of that note, of that note receivable, we will do debit note receivable, credit cash, right? That's there, right? So the company sells merchandise to a customer, right? So which has a 30-day terms. So of course there would be a normal sale that would be there, right? So there might be interest that might be coming up in this, right? So you might have to record that as well, right? So whenever it's given back to us, it's debit cash, credit notes payable, right? We will need to get rid of that. We will get our cash back. Okay, so there might be more cash coming in. So in that situation, there might be interest component side of things as well. Normally 30 days it's normally in a sell scenario, it might be common, right? So it's just the terms of different business, it just is different. It says that, account receivable, like, just for not giving cash but giving the sales amount as a note receivable. We can transfer it to note receivable, but it just depends on different scenarios. It could be done, it's not a big deal, right? It can be done. Right. So this is normally done initially, but whenever there is a maturity or whenever they are paying back, right, what would happen is that we would need to uh, calculate the interest rate, right? So suppose 1000 was lended out, right? And what happens? $12 interest rate and $60, 60-day note, right? So 12 is annual rate, so we need to divide it by the year and the day, right? So $20 would be our interest, $12 is annual rate, right? So we are computing the rate for the particular number of month. Right. So on maturity date, what would happen? On maturity date, what would happen is that we will receive a interest income of $20. Note receivable would decrease by 1,000. Debit cash or bank, right? 1,020. Okay. So that is what happens. So if it is paid with cash, right? But if it is not, in that scenario, if it were to receive another notes receivable, what happens uh, is basically we would have 1,020. If we are capitalizing that, let's just say that interest, it would look something like this. So debit note receivable, credit note receivable, credit interest payable. Okay, in this it's just multiple cases. Basically, that's what they have given. So if they only paid us the interest but not the amount, right? But they received another notes receivable. In that scenario, we would get cash of 20. Note receivable would be 100, 1,000. Right. So initial notes receivable would be credited and interest would be credited as well. Okay. So, if it just depends on the company how you want to treat it. Okay. So, if the company dishonors the note and it does not pay, we can move it to, accounts receivable. Right. So, in that scenario, what would we do is we would, of course, not only put the note receivable, but also the interest in account receivable. Okay. So, it might be that, this account receivable has been moved, and then if that is also not paid, then there would be interest, and then that would again be capitalized. It could be the whole cycle again and again. So what it is trying to say over here is that when we capitalize this, right, when we change the notes receivable to 1,020, the interest also changes, right? So earlier it was just 1,000 into 10%, right? Whereas now what would happen, it was like this, right? It was something like this was giving 20, right? So now what would happen, the interest would also change because our amount has also changed. Okay, our notes receivable has also changed, right? Our principal amount itself changes. That's why the company has a possibility of earning more interest. That's there, but they might have a chance of losing their capital as well, right? So it just depends on different company policy. You can definitely have a look at it. Okay. And as I mentioned, there could be a doubtful debt, doubtful account. If it never pays, we might have to expense it out as well, right? We might need to do that as well. And next is regarding uncollectible accounts, right? So company extends credit to customers and it gives them 30-day so payment terms, right? So of course when we sell 3,000, it's account receivable and sale 3,000, right? And when we receive payment, it's debit cash credit accounts receivable, right? However, if the customer defaulted, right? So there could be two methods of recording bad debt. Okay, so it could be direct write-off method. So company they normally don't do this, right? There could be allowance method. Yeah, right. So So it just it's a method is basically how frequently the company anticipates, how it will experience bad debt. Okay, so it just depends on different company, right? It just depends. So on a cash business such as movie theaters, petrol pumps, and all, it's not there. On a direct write-off method, as the name suggests, what happens is normally whenever we have to write off anything, what we do is we basically do debit bad debt expense, credit account receivable. Okay, so we simply expense it out, move it to expense. Okay, the receivable. But if the company is able to recover some of them, some of the cash, what we do is we basically do debit cash, and whatever is remaining we put it in bad debt, and then we clear out the accounts receivable by the amount. Okay. But if the customer pays off, pays off the write off, we will need to flip over the previous transaction, right? That could be there, but in that scenario, what would we do? We would book a AR of 3000, right? And we would get the cash 3000 and then cash receivable of 3000. Okay, so similarly it's just reversing that transactions. Next is normally allowance method. This is more likely used. So what would we do is we would record expense, but we would have a allowance as well. Okay, so it keeps on provide adding allowance at a certain time. Okay, it just depends on the practice, right? So uh, so if it was, bad debt estimate was 15,000 for the year, it would basically book it like this. So on a sale, on a accounts receivable, what it will normally do is basically, so if whenever it has to uh, write off any accounts receivable, so since the expense has already been booked over here, bad debt expense, right, at a particular period it has to get rid of the accounts receivable, right? So in that scenario, what would it do is it would debit the liability account and credit the accounts receivable. Okay, that's what it will do. Okay, so if it was part, so suppose if the company customer paid some of the money, it would do debit cash, debit doubtful debt for the remaining amount, and credit accounts receivable. So if it was a restatement, of course, in that scenario, what would it do? Debit AR, credit allowance, debit cash, credit AR, right? Partial amount, what would happen? Debit AR, credit allowance, debit cash, credit AR, right? So another concept is there about net realizable value. So uh, AR is 97,000 and your allowance is 12,000. How much we expect it to go bad, right? And 85,000 is our net realizable value. Normally what happens is in the disclosure side of things, we normally tend to uh, admit on the balance sheet. So since uh, allowance is like a contra account, so whenever we look at the balance sheet, we would basically be looking at this together. Okay. Okay, so allowance method is basically used by companies which experience frequent bad debt. Right, so allowance is nothing but an estimate, okay, of how much AR we expect it to be non-payment. So normally this can be done in multiple ways. How do we determine the amount? Right, normally it's based on past practices. That's also there, right? So normally, suppose we expect it to be 8,000, right? So allowance will be 8,000, right? And this is not accumulated depreciation. What happens is whenever we overestimate anything, there would be balance remaining on the doubtful debt, right? It would be there, right? So 600 credit is already left over, right? So it would only take additional 7,400 to bring the balance to 8,000, right? So if we are assuming that it would be 8,000 for the year, so we would just simply use 7,400, okay? So if we underestimate, of course, there will be debit amount of 600 and we will need to uh, expense out 8,600 this year. Okay, so allowance method, there could be percentage of sales that we can assume. So 400,000 into 2%, so 8,000, this is the thing that we can expense out this year, right? But what happens in the next year, what happens is basically, suppose if the bad debt was only 7,400, so what would happen? We would have a balance of 600, right? So in the next year, what would happen? Right, in the next year, what would happen is basically if we were to expense out 8,000, there would be a balance of 8,600, right? Okay, whereas uh, it could be that there could be understatement and we would only be left with 7,400. So it could be multiple scenarios, okay, that could happen. So this is just a summary table of what to do. So these are the accounts that we have learned. You can definitely review this. Okay, bad debt related expense, interest revenue, and allowance for bad debt, right? I told you this is a contra account, account receivable. Okay, so in case of fixed assets and intangible assets, what happens is, so normally these are used over several years. Right. So whenever we purchase it, we do debit equipment, credit cash, right? And so we will need to expense it out. Or so since the value of it decreases over time, right? So we will need to record depreciation, right? So depreciation can happen in multiple ways. So mm, like you have equipment, right? So suppose if the equipment is 900 9,000.
transportation cost was 350, sales tax, installation, all that brings to 10,000, right? So that's the depreciable cost, right? So if we can sell it for any value, or if it will have any residual value, we need to subtract that amount as well, okay? Or residual value is a minimum amount, okay, when the asset is no longer functional, okay? So normally we will need to divide it. So let's say our fixed assets is 10,000 minus 0 if the scrap value is nothing, and we will need to divide it by, but how many years, how long will it work for? Suppose we have a machinery which will work for 1000 hours, right? So we will write 1000 in this scenario. It could be per output per hour, it could be number of years, right? So suppose if it is for number of years, we will simply do 10. So if it can be used for 10 years, it will be 1000 per year depreciation. Okay, so similarly we can do different hours, units and everything to expense out. So so since we are incurring that expense, right, so every year we are losing the value of equipment or equipment value by 1000, so that's why we are recording that as an expense, okay, because that much amount is already used up for that year, na? That's why. Okay, so normally we record depreciation expense and we keep it in accumulated depreciation, which is just a contra account of asset, okay. So your equipment will be 10,000, and at year 5 when you look at the balance sheet, what would happen is your accumulated depreciation would be 5,000 like this, okay. So whenever we are recording any depreciation expense, we would record it like this: debit depreciation, credit, not the asset but accumulated depreciation, and in the balance sheet it would be presented like this: equipment less accumulated depreciation, and then your amount. So our book value is nothing but cost minus accumulated depreciation. So in this case, book value is right. So what happens is, so whenever we look at the balance sheet in different years, right? So in 2012, 13, 14, equipment value would be same, but the accumulated depreciation changes over time. Okay, so the book value would also change, right? It would be, it would decrease, 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 right? By the depreciation amount. All right, so if we are decreasing by 8,700, and it would just be decreasing at that same rate of 8,700 over time. So accumulated depreciation is the value that has already been used up. Okay, whenever looking at the balance sheet of 2014, we see equipment of 27,900. So 26,700 means 26,100 is already used up. Now only 1,800 of the total value is remaining, right? So it's closer to becoming scrapped, basically. Or it just suggests that they will need to buy another fixed asset soon, or PPE soon, right? Okay, depreciation methods, right? So there are multiple ways of course, the entry is what we have already learned, right? Expense, and then using the contra account, accumulated depreciation. So in terms of method, so there is straight line method where amount is same, okay. The formula is cost minus residual value divided by useful years, right? Suppose a company purchased equipment 27,000, Residual value was 900, 3-year life. So what would be the depreciation? 27 minus 900, 27,000 minus 900 divided by 3, 8,700, right? So in the first year, in the year end of 2012, we would have accumulated depreciation 8,700, book value 18,300. Next year, uh, it would be, you would pass this entry, another year pass this entry, and that would increase the depreciation, uh, accumulated depreciation to 17,400. In the next year, it would be 26,100, book value would be 900, right? Then you can recover this cost by selling it out as a scrap, right? So there is another method called partial year straight line depreciation, right? So fixed assets can be purchased, across, across the calendar year, not only on 1st January, right? So in that scenario, we will use prorated number of months, right? So, it could be a little bit different, because in the first year we might only use it for 9 by 12, 9 months. In the next uh, year it could be used fully, but it just depends, because you might sell it at the mid period as well, right? So we will need to compute this very carefully. So in the first period we only used it for how many months? For 9 months, hence our depreciation was this much, 6525. Next year we used the whole year, that's why our depreciation expense was 8,700. In the next year it was 8,700, but when we sold it at mid year, we only used it until for 3 months, right? 3 months, yeah, 3 months. So in that scenario, what happened? Our uh, mm, our uh, depreciation would be less for only 3 months, right? So it would only be for 3 months. That's why we record depreciation at 175, but the accumulated depreciation, when we add it up, it would be 26,100. Okay, this is another, this is what happens normally. Okay, so it's not always January 1st that you're buying inventory, right? Or I mean fixed assets. So similarly, there is unit of production method, where we normally have cost residual value but divide by machine hours, right? So if the machine is supposed to run at 8,700 hours, we normally divide it by 8,700. Everything else is same, right? So in the, whenever we are depreciating, after that we first calculate what's the per hour depreciation rate, right? And then how much hour have we used in that particular year. Based on that, we normally depreciate it. So 2,100 into $3. Similarly, next year 2,300 into $3, right? So that's how we can do it as well, based on useful life. Next method is regarding declining balance method. Okay, so this is, it's a little bit different. Okay, so there will be a rate given to us, let's say 2 by 3, right? So
every year, so let's say 2 by 3 is what, 67%, right? So in the first year, what would happen? We will do book value into your rate, that's 18,000, right? That's the depreciation expense. Next year, what we do is we use the book value to calculate a new, using the rate, but we get a different depreciation expense. It would always go down. It will, the depreciation expense would, basically the book value will be going below, right? So it will be going downwards. Hence, our depreciation expense also goes down, right? As you can see over here. Okay. 18,000 is there, 6,000, right? It's just going down, right? Because what's happening? You are computing the depreciation again and again every year, not the same depreciation amount every year, right? That's why. Okay. And in the last period, of course, it's going to be depreciated down, right, by 2100. So of course there will be partial year declining method as well, because we won't be using it for the whole month, right? So similarly, we do book value into rate and we get the depreciation amount, but we also apportionate it as per usage months. We use for 9 months, hence 13,500. And next year onwards, 13,500 into the rate, we get 9,000. Similarly, we get 3,000 next year, right? In the last year, what would happen? We would have 20 something, 2,100 expense, depreciation expense, right? So we record depreciation as such, 13,500, 9,000, 3,000, right? And in the last month, we have to record 900 as the expense. We can record that, right? At the end, we can have a book value of something, right? So it could be there. So a asset which cost 27,000 has a residual value of 900 and useful life of 8,700. Right, in straight line method, what would we do? 27,000 minus 900 divided by 3 would give us 8,700, right? Based on units of production, what would we get? It would be 27,000, right? And 600 is the residual value that they have considered, and 8,700, it would be 3. It could be 900. There might be a typo in this, but just remember the method. Okay, so it's $3 per hour, right? In declining method, what happens? We are given 27,000, the rate amount of depreciation. Next year on, we do 6,000, right? In the another year, it would be 2,100, right? In the final year. Okay, so all this method basically affects our depreciation amount as well. Okay, so it depends on different jurisdictions. Some people use uh, straight lines, some declining, depends. manufacturing units of production is used, right? So whenever we are selling this particular inventory, or I mean fixed assets, there might be gain or loss, right? Right. So whenever we are discarding or disposing any fixed assets, so there could be three scenarios, right? So we are discarding it for nothing. It could be a sale. It could be an exchange, right? Of course, there will be depreciation and all, but whatever the book value is, right? Whatever the book value is, based on that, we determine whether it's a profit or loss. So let's see the example over here. So we've got this truck, 35,000 that we've purchased. We've got this depreciation, right? So as we can see, the truck is not worth anything, right? The truck is not worth anything. So when we are discarding it now, what would we do is we will do debit accumulated depreciation, credit truck. Now the ledgers are cleared out, right? So what would happen? It would look something like this. In trucks ledger, it would be 35,000 credit, and in accumulative depreciation, 35,000. Right? That's how the FA ledger would look like. So suppose we have a truck value of 35,000. We have a depreciation of accumulated depreciation of 28,000. So 7,000 is the book value, right? So when we sell it at a loss, right? So in that scenario, what would happen is we would need to book a loss on disposal. Okay. So suppose we only received 28,000, right? In that scenario, what would we do? We would book a loss. Okay. So debit loss on disposal of truck, debit depreciation expense, right? Credit your truck. Why are we doing credit truck? Because we want it to be zero because the company no longer owns it, right? So normally we determine the book value, compare it to the cash received. Based on that, we can determine if it's a break even, gain or loss. Okay. So normally we zero out the fixed assets by crediting it, zero out accumulated depreciation by debiting cash, debiting loss or crediting gain. All right. So in this scenario, what happens? So if the book value is 7,000, cash received is 7,000. So what would we do? We would do debit cash 7,000. Right. Accumulated depreciation is what? 28,000. Right. So we receive the same book value amount. Right. So there is neither gain nor loss. And then we do credit truck. Right. If we are selling it at loss, what would happen is that so we have a book value of 7,000, we received 5,000, loss of 2,000, right? So our loss would be 2,000, cash would be 5,000, accumulated depreciation would be 28,000, and truck, since we don't have that fixed assets because we sold it,
So we will credit it by 35,000. Okay, so this is what the entry will look like. In case of gain, what would happen is we receive 10,000, right? So cash 10,000, accumulated depreciation 28,000, right? So our book value is determined by what? 35 minus 28. That's why we've got 7,000. And we need to get rid of the truck. We do credit 35, right? And what happens when we get there is a gain as well, so we will need to record it in PL as well, right? Gain of 3,000. Okay, so of course this is just a fixed assets partial year, right? So it's just saying, just calculate uh, fixed assets for the partial year, and based on that book value calculate the profit and loss. Okay, so the book value is 5250, cash received was this, so $250 was a loss, right? So it's just saying, rather than like, selling it at the beginning of the period or end of the period, where the depreciation is fully accounted for in every month of the year, we normally do a partial depreciation for the month, for the year we are selling it, for how many months we've used, and then based on that calculating the gain or loss. Basically it's just that, that's it, nothing else. So it's just saying how we can do, what steps should be done in terms of exchange of fixed assets. Okay, so if we are doing an exchange, we suppose that our trading value is same as the book value. In that scenario, no gain or loss will be booked, right? So this is very much similar. So we do debit truck, the new one, debit depreciation, credit the old truck, right? And then we do credit cash as well. We might have to add some more cash in it as well, right? That's why. So there might be scenario where we are using, exchanging fixed assets, uh, right, even with a loan, right? So in that scenario we will need to book a loan payable or any loan related account. It could be note payable, it could be another kind of loan, right? So it's a notes payable, so we are recording that we are only paying 20,000. So whenever we are trading in, but we only received 5,000 out of 7,000. So we have a loss of 2,000, but we are using notes payable or a loan as well. So in that scenario, what happens? So we will need to record the loss. We will need to record the new inventory or new asset, which is truck, accumulated depreciation debit, credit your old truck, credit your cash out, credit your loans payable. Okay, whenever we are exchanging any fixed assets with a gain, right, in that scenario what would we do? We will definitely have to book the gain on asset. Okay, so of course new truck debit, accumulated depreciation, credit your old truck, credit cash, notes payable, right? Similarly for partial year, of course it's saying like, calculate the depreciation until the month, and then after that determine your gains or losses. So gains or losses on income statement, what happens? So normally we would definitely we would not present it in operations. We would present it in gain on sale of equipment, and gain or loss on sale of equipment, like this. Okay, so similar to depreciation, there is amortization that happens in case of intangible assets. It's very much similar to uh,
similar to depreciation, let's just say that. So if a patent has a life of 20 years, we depreciate or amortize it over its period. Okay, so 12,000 patent life is 12 years. So amortization expense, credit patent, right? Okay, so similarly, there might be domain names, trade names, goodwill, right? So which has indefinite life, right? So if it can't be determined, it will not be amortized. Okay, if the useful life is determined, it can be, otherwise it's not. Okay, so normally assets are classified into current assets, long-term assets, PPE, right? Fixed assets, intangible assets. Okay, so 12-month window, long-term are multiple year, and fixed assets type, right? And this is intangible, which can't be touched. Okay, so that's how it's done. So this is how we can make a change to asset. Okay, so that's it for this particular chapter. So this is the statement that we discussed, right? So mostly regarding amortization and gain on sale of equipment. There was something regarding fixed assets and all, and patent that we discussed, right? Nothing much of a big thing. Next is regarding investments. So investments in securities or anything, we normally tend to record it in, debit your asset, right? So investment in stock, we would basically do debit to increase, right? So investment in stock. So there could be all this journal entries, right? So whenever we purchase out, we give out cash. We receive dividend payments. We have a income from it. We recognize any other capital gains. When we sell it, we have to adjust the fair value sometimes, right? So where we need to, depreciate, where we need to remove the value from the investment, right? So whenever we purchase out the stock investment, what happens? We normally, as I said before, we normally do 50,000, right? And credit cash ledgers would be similar. Whenever we receive any dividend payout, right, under every kind of method. So there could be fair value method based on market price or based on equity method, right? So what happens in that case? Debit cash, credit dividends revenue. Okay, in both method, it's mostly the same thing. Okay, but equity method is how they pay dividend based on your number of stock. Okay, so we need to recognize the income, right, in both cases. So whenever another company reports any net income, we don't need to recognize it, but in equity method, we do need to recognize it. So Since our share is 25%, so in that scenario, what would happen is we will need to recognize the 25% investment increase and credit our revenue investment income by 25,000. Okay. In fair value method, what happens is we might have to sometimes, recognize or holding gain or loss. Okay. So if the investment increased by 10,000, right? So might have to realize any kind of gain or loss in income statement. Okay. So in equity method, it's a cost method, so we don't need to do anything in it, right? This would be same. In our case, what happens if we have a increase in the value, right? We will need to recognize it. Debit income statement, credit unrealized gain or loss, right? It's not yet been realized. That's why we credit 10,000. Okay. So whenever we sell anything, what do? We basically, first of all, get rid of the unrealized side of things as well. We will need to empty out this account as well, right? So when we sell, let's say in equity method, we receive cash, credit your investment, credit any gains or losses, debit losses, of course, right? In case of this thing, in case of your fair value based approach, we receive the cash, credit investments, right? So we will need to account for the gains and losses side of things as well, right? So since there was a loss of 2000, we have a book value of 58,000, and when we receive 58,000, we just simply book it, right? So our unrealized gain or loss, it had a gain of 10,000. Later on, it was 2,000, right? So the net value came out to be 8,000, right? So that's why we will need to get rid of this unrealized gain or loss. And once we sell it, that will become a realized gain or loss. Okay. So investment as well, we can classify it as, short term versus long term, right? Normally in income statement, there is a other comprehensive income that comes out. It's where we will record all this gain or losses, okay, in investments. So in current assets, we classify 12 months base securities, or more than that in long term, of course, right? So it will be reported over here. Okay. So normally what happens is basically, so 20% shareholding, it just depends, it's like, where if we want to recognize the unrealized holding or not, and how we want to present, it's not only this that affects it, but the standards and all that affect it as well. Okay. So similar to that, there is investment in bonds, right? So of course, whenever we get any interest, we recognize the interest income, right? We might have to amortize, might have to adjust the fair value, sell the bond investment, right? So all these things are there, right? So when the investment is done, we credit out the cash, right? And when we receive any interest, in that scenario, we do cash, credit investment revenue, right? And when we have to amortize it, what we can do is we can simply do uh, 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 just do investments and credit revenue, right? So that's your revenue coming in, right? So that's one side of things. So in case of premium amortization, what happens is basically market rate is higher. In that scenario, your interest revenue would decrease and your interest would also decrease. Okay. So it just depends on how, the market price is as well. So whether it's a discount or it's a premium. Okay. So based on that, our ledger balance will look something like this. So whenever we held any securities till maturity, we normally tend to have, all this money coming in, which we might be reinvesting in it as well, right? So there might be different scenarios, right? Or in case of premium, what happens is basically we will be reducing uh, the investment amount by 75,000, right? And at the year end, it would only, so every year it's reducing by the inflows, and then basically year end we get the capital payment back, right? So we just are accurately defining it over here, that's it. So when we sell any bonds prior to any maturity, we normally tend to receive a cash, let's say, and there might be a sale again as well, or there might be a loss, right, based on its book value. So the carrying amount was 5075. If we sell it at that amount, we have a loss of 20,000. There might be gain as well, right? So we have to record it accordingly. Right. Next is regarding purchasing bonds with accrued interest and partial year amortization. So whenever we purchase bond, right? Of course, the initial entry is there. In a partial year, what happens is we receive uh, some interest as well. All right. So interest revenue is would be debited by 5,000. Your cash is 4705,000. All right. So in a partial year kind of scenario, right? Whenever we receive any interest, of course, there will be cash increase. Credit your interest revenue, of course, right? So whenever we are amortizing it, of course, we have similar sort of entry, just the amount is a little bit different, right? So whenever we are selling bonds investment with accrued interest and partial year amortization, it's a little bit different, I would say, uh, investment wise, right? So based on the book value, right, we would record any loss or sale. It's basically the same concept, okay? But it just depends on how we are doing it. Okay. So it's a similar way of doing it. That's it. So whenever we are trading any securities, we would definitely recognize any unrealized gains or losses, right? So if there is any revenue we receive, we definitely have to recognize that, right? And there will be amortizations that will happen, right? So when our stake increases, of course, so we will adjust for the fair value, right? In credit your unrealized gain or losses account, right? So that will come over here in the other comprehensive income, as I mentioned before. So of course this will also be closed out to retain earning later on, right? Okay. So if it is available for sale in that scenario, we would not recognize it immediately, right? It just depends on the type of it as well. So whenever we sell it, right, in that scenario, what would happen is basically we recognize this uh, unrealized holding, right? So our ledger account would look something like this in case of partial, I mean, available for sale securities, right? So our book value was how much? Uh, Fair value was this much, carrying amount was this much. So we had a loss of 2000, right? So we will recognize that. This should have been over here. Okay. So similarly in the ledger accounts as well. So if there is any losses, we will have to recognize that. Right. So normally the concept is, normally what happens is, so whenever whatever is remaining over here, right? So suppose if the balance is 50,800, right? So the fair value is that much, right? So in this scenario, what you would do is your cash would be 8,000, right? And then you would basically be recognizing gain of 8,000, right? And then credit your thing, your unrealized gain or loss of 8,000 as well, right? And credit your investment of 50,008. This will be zero, huh? Okay. So it's just, first of all, you will need to take care of unrealized gain or loss, and then first of all, you will need to adjust all the losses from there, and then based on that, you move ahead. When you sell it, you simply record debit cash, credit your investments, and that's pretty much it in this scenario. But of course, you will need to account for the losses as well. Right, so 2000 loss was already recorded right earlier on over here somewhere. Over here. Right, so similarly in the other case as well, we will need to account for the same thing. Okay, so whatever is available for sale, right, so whenever we receive 50,800, that will be there. So that's the normally unrealized gain and losses are already booked, so that's why we can simply expense out this value. Okay, so that's how we can uh, account for all these assets. In the next chapter, we will be covering about liabilities and all. So thank you for your time. Take care. If you have any questions, do comment down below. Thank you. Take care. Bye bye.